Welcome to Market Movers. I'm Jim Urio with Scott and Mark.
Hi, Jim.
So, Scott, we have GDP numbers tomorrow. Too early to reflect much of the macroeconomic impact of the coronavirus. Is that? Do we need good GDP numbers to think we have a cushion? Is that the only thing we're concerned about? Or are we concerned with other things like phase one trade deal, Boeing, political uncertainty? I know it's a lot of questions.
It is a lot. Right. So to me, we don't need the number as bad as we maybe did a couple weeks ago, Jim. But it would help to have a good number rolling into the things that you mentioned because of the fact that some momentum build, let's say, in the face of this crazy market volatility, I believe would help, say, assuage some of the concerns that are out there macroeconomically because of things like the coronavirus.
But the economic impact of the coronavirus is probably number one.
It probably is, and that also relates to other things that are going on too that I believe the market's concerned about, besides political uncertainty, which happens to be the Federal Reserve, for in fact.
Now, before we dive into our trade discussion, I'd like to point out that these are examples, not recommendations or advice. When we price these out, the ESE mini contract was trading about 31.20. Scott?
Yeah, Jim, 31.20, give or take, 25 handles if you got a time to flip a coin. So this is a very interesting, fast-moving market, and one where you're going to see a lot of movement in option prices particularly. And so there was a lot of things out there I was looking at when pricing out this trade today that were, as an example, that were just, I think, all over the map with respect to what you wanted to spend and areas that you should look at. So specifically, Jim, looking at today, buying the March end of month 3,200, 3,250 ES call spread for 18 ticks. This trade risks of 900 to make a potential 1,600. It goes all the way to the end of March, so it expires on March 31st, as I believe we get through some of this market volatility and the market kind of just settles down a little bit. And because of that long period, I'm paying quite a bit for this call spread as far away as it is now. You know, some 100 points or 80 points or so when we price this out. But this is just a way, in my opinion, to get long or get some longer exposure, but at a longer date after the volatility comes down from virus
looked
issues
at
and
this
whatnot.
volatility and the VIX at 27, 28, were you tempted to sell an out-of-the-money put, and why didn't you?
You would be, right? Because of the fact that this just feels like a market that has a lot of pressure on it and things like that, but the volatility being so high, Jim, and the cost of that being such to where there's risk there.
You don't want to be long.
You don't want to be, right, exactly. There's just too much risk there in the sense that I believe by defining my risk on this call spread is the way to better be, say, long biased.
I agree,
in this
and
market.
I like this. If you were just buying a call, I think it'd be too expensive with a 27, 28 VIX handle, but to buy a call spread where you're buying and selling, I like it a lot. Now, I'm looking at the micros, and I'm thinking the same thing. I think 3,100 is a level of some interest, and I'm hoping that it provides some support. So I'm looking at buying the March micro at 31.20 with a stop at 30.80 and a target at 31.90. It risks 200 to make 350. Thoughts?
Just a little tight for me, given the volatility and just given the fact that
that's
we
valid.
see 30 handle moves in a matter of 10 minutes these days. I mean, that's the market we're in. But the levels are good. I believe that's where, and I picked 32.50, by the way, on the top end of my call spread. That's the market kind of gap down open that we had on Monday. So if there is any, say, buoyness to this market and we do get some rallies, those are areas you should start looking at, especially when we get these gap down opens on Mondays and Tuesdays and so forth, to where those levels may come into play again with respect to where the market might trade out.
Are we expecting a coordinated central bank liquidity injection to combat this issue?
We are. I think the market is definitely showing that. I mean, look at some of the Fed Fund futures numbers. Now, if that has a long-term effect, that's really the interesting thing to look at. But there will certainly be some sort of short-term effect that we always see from liquidity injections. Just how long does it last?
Thanks for joining us on Market Movers. I'm Jim Urio, where we are helping to make you a better trader.